Hi traders, it's Fabio and welcome to this video in which I'm going to be explaining the basics of Fibonacci. So how can you use Fibonacci to your advantage when taking trades? What is the Fibonacci retracement tool and what are Fibonacci extensions? All of this and much more are going to be explained in today's video alongside a full trade breakdown of how you can use Fibonacci in combination with liquidity and supply and demand. Now make sure to leave a like underneath this video, make sure to subscribe to the channel and let's dive straight in. Alright, so when you open up your chart, the first thing that you are going to want to do here on TradingView is go to the left and select the Fibonacci retracement. So this is going to be the third box that you can click here on the left. Now, when you draw in the Fibonacci retracement tool, you're probably going to see all of this. So a lot of different colors and a lot of different levels. So what I want you to do is double click on the Fib retracement tool and we're going to set it up all together to have, or make sure that you have the best settings possible. So what you need to do is just quickly turn off everything. So what you can do here is select all these ticked off boxes and you can simply turn them all off. Now all you need to select is the 0 and the number 1, and what I'm going to do here for my chart is give them the black color. Now, I'm going to turn off the background, and as you can see now here on my chart, I have the 1 and I have the 0 line. Now these are going to be the two most important levels because the way that a Fibonacci retracement tool works is that you draw in your fib from the swing high down towards any given swing low, and the overall Fibonacci retracement tool is then used to measure up a pullback and then also anticipate on what could be the potential impulse. Now the most important levels that you are going to need to take into account when trading with the Fibonacci retracement tool are the 0.618 and the 0.786 and the 0.328. So these are going to be the three most important levels that you're going to want to have drawn in on your chart. And again, what I'm going to do is I'm going to give them the black color because for me at least that is the easiest way to identify the overall fib levels. Now you can further customize your Fibonacci retracement tool by, for example, turning off the trend line, and if you would want, you could extend the lines left, but you can also extend the lines right. For myself, I just like to keep it nice and simple. I even tend to turn off the prices and also want to turn off the levels, as all I simply need are the overall lines themselves. But for the simplicity, we're going to keep the levels drawn on and we're going to move them to the right side so it's nice and easy, and also the overall price itself can then be seen. Okay, so now that we have the Fibonacci tool set up correctly, what I need you to understand are that these are the main Fibonacci retracement levels with which the market is likely going to interact. And the key level, which you probably heard about in the past, is the golden level, which is the 618 Fib retracement level. Now, this level together with the 786 is going to be your most important Fibonacci retracement level. So what these Fibonacci retracement levels are ultimately used for is to anticipate on how deep a potential pullback is going to take place. And all you simply pretty much want to be doing is you want to be drawing this overall Fibonacci retracement tool in from the overall swing high in towards an overall swing low. So what we do is that we measure the overall impulse. So let's say we see this as one big impulse down that, let's say, broke this key level of market structure. We can then say this is the swing high, this is the swing low, and then the overall key levels that I'm going to potentially see the retracement happen in towards, that is going to be around the 618. So as you can see, the market retraces back up here at that 3 to 8 level. It starts to find some difficulty, after which it starts impulsing again, and then as soon as we reach around that level between 618 and 786, that is where the market tops out and then eventually heads down lower once again. Now on the second occasion, what we again do is that we measure out the overall swing impulse in towards the downside from this high in towards this low. Again, we see an overall break of structure happening both here and here, and what you see happening is that the market retraces initially to the 618 over here, it tops out and then eventually heads down lower again, after which it finds support at that 328, which happened over here, and then from there the market pushed up higher again towards the 786, from where eventually it headed down lower and formed a new lower low. So this is how we use those Fibonacci retracement levels. Now, next to the fact that you have Fibonacci retracement levels, what's important to know is that you also have Fibonacci extension levels, and the most famous Fibonacci extensions levels are pretty much just going to be the 618. So what I tend to do is here the minus 382, and what I tend to do is the minus 618. So let me draw that in for you guys. That should be this. So the minus 618. So these are the two most important Fibonacci extension levels that I use. And Fibonacci extension levels are nothing more than levels where you expect the market to potentially find support. Now, as you can see over here, this particular example, at that 382 Fib extension level, that is where the market finds support, from where it eventually rebounds back in towards the highs, okay? So this is how we use the Fibonacci retracement. We use it to measure up a potential pullback. The key levels to keep a lookout for are the 328, the 618, and the 786. And for Fibonacci extension levels, the key levels to look out for are the 382 and the 618 as well. Now, how do we actually use this tool in combination with all these other different confluences that we like to use? Now, myself, I personally love trading with supply and demand, market structure, and liquidity. So that's exactly what I'm going to do here for you guys today. And the main confluences that I myself tend to use are going to be number 1, MS, which I'm going to be calling market structure. Number 2 is called liquidity. Number 3 is S&D, also known as support and resistance, supply and demand, or as fair value gaps. And then number 4 that I like to use is the Fibonacci. And then number 5 is pretty much just an entry model in itself. So these are the 5 confluences that I'm going to be using here today on my chart. I'm going to be running you through them all one by one. Now, first of all, if we look at market structure, are we bullish or are we bearish? Well, I think it's very clear. We have a high, we have a lower low, we have a lower high, we have a lower low, a lower high, a lower low, a lower high, and a lower low. So the overall market trend and direction is definitely bearish in towards the downside. So in this particular example, what we can do and what we can say here is that this, for example, is my swing high and that this here is a swing low. Now, this is the overall kind of like swing that I'm looking at to trade further in towards the downside. Now, if I look at the second point or the second overall confluence, I'm going to be looking at liquidity. So how do I identify liquidity myself? Well, I look for certain swing points within the market. Now, these swing points within the market are for myself little areas of price where the market made a pullback, but then eventually headed down lower again. So I would say this, for example, is a swing point in the market where liquidity rests above. That is also why when the market comes above that liquidity point, it tends to head down lower once again. Now, in this particular piece of price action, there are now 2 areas that I identify as potential liquidity points. Myself, I'm looking at this overall swing high over here, and I'm now looking at these equal/descending highs over here as well. So I have 2 areas within the market where I'm identifying potential liquidity. Now, preferably, I would want to see the market take out this liquidity point, which it just created over here, because if it took out that liquidity and it still respects this high, it will also still respect my stop loss. So the liquidity has now also been identified. Now, the last part is identifying my supply and demand and the Fibonacci and the entry model. Now, when it comes to supply and demand, it's fairly simple. All you're actually looking for is, very simply said, a buy before a sell. In this particular example here, what we have is a buy up before a stronger sell down that broke market structure here and broke market structure here as well. So what this actually means to me is that this is my valid area of supply. Now you can see the market already tapped into my supply zone and it headed down lower again. However, at that point in time, we did not yet have the liquidity confluence, and therefore this for me is no valid setup, because if I do draw in my Fibonacci retracement tool, you can already see that it reacts and it interacts with that 618 Fib retracement level and then starts heading down lower. So yes, you could have potentially already just, for example, traded the overall 618 with your stop loss above the 1 Fib, targeting that -382 Fib extension level. This is a way to trade the Fibonacci. Personally, not my favorite way, but it is definitely a way that you can trade it. However, what I often then see is that the market tends to come back up in towards the highs. It then grabs the overall liquidity point, which I mentioned previously, which are these 2 descending highs over here. So the X has now been taken. It retraces into the 786 Fib retracement level, which again is a key Fibonacci retracement level. And I'm now looking for my entry model, which is the bearish confirmation. So the bearish confirmation is now provided with a market structure shift on the individual candlesticks, is the way I like to call it. So what we see here is that the market provides me with that fractal structure shift, with that market structure shift. And the way that I can see it here on my chart is that the market pushes up, it pulls back, pushes up, pulls back, pushes up, pulls back. And then here, if we look at the individual candlestick, you can very clearly see that we saw a break structure again over here after breaking this high. So we get a push up, a retracement down, and then another push up. So at this point in time, what I'm now waiting for is for this low over here to go. And if I were to, for example, go into, let's say, the 8-hour time frame, you can then very clearly see that that is an overall push up, a pullback, an overall push up. So I'm just looking for an 8-hour break of structure, for example, but on the daily time frame, it can be seen as an individual candlestick. And my entry model then clearly states that I can just simply enter on the low break of that with my stop loss above the 1 fib, because that's important to note. You always expect the 1 fib itself, so the start of the overall impulse, so the overall swing high, to be respected and the market to not move past that point. So that is why a lot of traders tend to place their stop loss above the 1 fib. Something else that I see a lot of traders do, and what you can also do, is use a Fibonacci level, which is the 0.88 Fibonacci retracement level. That is also a level that a lot of traders use for the stop loss. However, in this particular example, you can see that if I were, for example, to refine my overall supply zone to these two imbalance candles, which we have here at the top, that your stop loss would have been swept. But at the same time, this is a tap into a supply zone. So I'm not very sure if you, as a Fibonacci trader, would have wanted to place your stop loss on that 0.88 Fibonacci retracement level. That's why personally I'm just a bigger fan of trading the overall, let's say, wider stop loss, as I've done in this particular example. Now, what we then wait for is for the market to tag us in. So as we can see here now, we get tagged in, and then from there, the market tends to continue lower, back down in towards our take profit level. We're at that minus 382 Fibonacci extension level. That is where the market kind of like bases out and tends to find its support. So this is how you can pretty much trade the Fibonacci retracement tool and use also the extensions for take profit levels. If you have any questions about this video, make sure to let us know in the comment section down below. I hope it was clear for you with the help of this overall trade breakdown. Thank you for watching. My name is Fabio, and I hope to see you very, very soon here on the channel again. Thanks.